How you doing today, Mr. Sunheim? So we're gonna finish our price floor and ceilings by talking about price floors. So let's look at this picture right here. Price floors is just the legal minimum that you can pay, and there's of course two types: binding and non-binding. So here, this example, we're gonna do the eyes of my company, and we're gonna be selling market equilibrium for Travis Scott concert tickets are $20. Here's the equilibrium quantity, your supply, your demand, and you have your price floor right here. Now, this is non-binding. That is because it's below the equilibrium. So the minimum is, I don't know, this is $5. We say the minimum right here is $5. That will not affect the equilibrium at all because they're not even trying to sell it for $5. So if they're selling it $20, but the minimum is $5, the price is always going to still be $20 for equilibrium. That's never going to change because this is not affecting it. For it to be affecting it, it has to be above the previous market equilibrium. And that's when you have right here. So your market equilibrium for the concert tickets were $20. Now, the government puts on a price floor. Shoots up, bam, the minimum you can charge now is $50. Now this is a binding one, and now this is going to cause some changes. So let me back up a little bit. So as you can see from the price floor, this right here is going to cause a surplus. That's the word I'm looking for, surplus. Now that is because now the price is out of reach of people that can't spend more than $20 or can't spend $50. You see, you lose a lot of customers. Now the price is like, this is too expensive. Now when the price increase, you're gonna have a lot more suppliers that are gonna hop in, think they can make a profit because instead of selling carrots for $5, you can sell concert tickets for $50. You make a bigger profit. So you're gonna have a lot of supply. So you look right here. This is actually the quantity being demanded, and this is the quantity being supplied. Now you see it's problematic because you have more of the product being supplied than now be purchased. So that's why you have a surplus. Now this also creates another thing, your deadweight loss, which is right here, which is just the cost of society created by the market insufficiency. This is all it's losing. Now if you also look right here, producer surplus went from here to now this whole region right here. Consumer surplus went from here to now here. And that's the changes right there. How you doing today, Mr. Sunheim? Today we're going to be talking about, we're going to be talking about price ceilings. Let me make sure you can see my picture right here. And we're going to be explaining what all this means. So the first thing we got to talk about, flip it over, is the definition of a price ceiling, which all it is just a legal maximum on the price at which a good can be sold. So what it's saying basically is it's basically saying the highest the price can be sold on the market. And this leads to, we have two types, non-binding and binding. So right here, this is non-binding. Let me show you what I mean. So if I'm selling, through the eyes of my business, I'm selling Travis Scott concert tickets right here. And the equilibrium price is $20, and the equilibrium quantity is 100. You have supply and demand. And then I put a price ceiling on it, $50. But the market is already selling it at $20. So this does absolutely nothing because the market will keep selling it at $20, even though the max you can sell is $50. Even though it's not going to do anything. So this is what it means by non-binding. It's not doing anything. Now, if we come over to the back, here we go, right here. I'm gonna explain this right here. So you got your supply, and you got your demand right here. Your equilibrium price is $20. But the price ceiling this time is below equilibrium. equilibrium, where it always has to be an effective price ceiling. And what does that do? It lowers the price. So the price ceiling, let's say, goes from $20 to $10. And then it creates a thing called a shortage. And this right here, so let's say the demanded quantity is 125 because the price is lower, more people want to buy it now. That's what it's saying. Price is lower, more people can afford it now or are willing to buy it. But the only thing being supplied is $75 because if you think about it, if I am a supplier and I know, dang, the price is lower now, I'm going to make less money. I'm gonna produce a lot less of it because I'm going to be losing money. So that's why the being supplied is less. You create a shortage because you have people, the amount of people that want it exceeds the amount being supplied. So then you have long lines at stores or you have rationing of the product. It also creates another thing, which is dead weight loss, which is this region right here. I remember this when we did it in the forest with the trees. And all the dead weight loss is just basically just the cost to society created by the market inefficiency. Because now this is all inefficient. The equilibrium is all out of whack. And it decreases producer surplus and increases consumer surplus. Now, what do I mean by that? Well, if you look right here at the original line, this used to be consumer surplus right here. And then this used to be producer surplus. Now the ceiling, consumer surplus now goes down to here. And you increase it. And producer surplus went from here to here. And that's everything on price ceilings. Today we're going to be talking about taxes. Now you have two types of taxes. One that affects the producers and the others that can affect the consumers. So in this example, so basically when it's affecting the consumers, then it's the demand that's going to be shifting. Because if they got to pay tax on it, you're going to buy a lot less of it. So the demand curve is going to be shifting. But since in this example, it's a tax on producers, the supply is going to be shifting. Because as they're being taxed, they have less money to put into their companies. It's less appealing. So the supply that they're going to be giving out is going to shift to the left. Now, as I break this down, what's going to use the Eisma company, and we have Travis Scott t-shirts right here. And the price is $3 at markup equilibrium, and quantity, the quantity was 100. Now, let's say the government puts a $2 tax on it. Now, this tax burden is going to be split between the producers and consumers, but that varies depending on the product. So now it goes up to $4, and the quantity goes to 80 because it's a lot less being demanded now. Now, I get what you're saying. If it's a $2 tax, why did it only go up $1? Because it is shared. And you can tell how much is taxed by if you're looking at the distance between the two supply curves. So here to here, you can tell that's $2. Now, if we take this 2 times it by 80, that's 160, and we get our tax revenue that the government is making. This also affects producers and consumer surplus. As you look right here, it went from here to now here. Same thing here. It went from here to now to here, which now creates dead weight loss right here. And now, make sure I covered everything. And then you can see that the revenue that is going to the consumers and that's going to the producers. And then flip it over. And here's 3 more examples right here. of how it varies depending on like the product being sold. So when the demand curve is very inelastic. So let's say, insulin, where the demand's not going to shift that much. Or in my company, let's say Travis Scott's tickets are inelastic. People always gonna have to pay that same price because they need it. So that means the consumers are going to pay for all of it. Now, right here, this is relatively inelastic, and the producers are going to pay most of it. Not producers, consumers are going to pay most of it. And this is right here, all consumers. But if you have right here, like this, for example, perfectly inelastic, where it's basically saying if the price goes above a number, nobody will pay for it. But if it's below, then the amount being paid, being bought will be infinite. So they can't have it go over that price. So that means producers will end up paying all that tax. And that is taxes.